and welcome back to our third segment for ethics. So just again, building off with where we left off in our last segment. So today we'll be talking about in this segment TIA, and also we'll be looking at some of the ways that there can be some changes in insurability. All right, perfect. So the first part that we're going to be talking about is the TIA, and what that stands for is Temporary Insurance Agreement. This is something that when life insurance is issued, the client has this option of getting a TIA. And what's important here is that it's the agent's responsibility. So this is, if you are the agent that is sitting there with your client, it is your responsibility to issue this TIA. Now, what is it? What is the purpose? So all it is, just as the name suggests, is it's a bridge, right? So let's say if your client has a policy for $500,000, we know that the policy is not going to be issued right away as soon as you walk out the door with their policy. It's going to take some time because it has to go through the underwriting process, and it will take time for it to be approved and it to be actually be enforced. Now, let's say that takes 3 weeks, let's say it takes a month. What happens during that time? Is the client covered? If something happens, is there any coverage? No. So this is where the temporary insurance agreement comes in. It's that bridge between when the agent leaves the door to when the agent comes back with the policy being enforced, right? So temporary, and it's just giving that sort of protection. Now with this, there's 2 conditions only that need to be met for the TIA. The first one is that you need to answer no to all 5 to 6 questions. Now, what are those questions? Because it's a TIA, it's something very quick and on the spot. There's not a lot of time for the insurance company to sort of take their time to issue this. So they have 5 to 6 major questions that we might be dealing with if the person has any severe illness that they know of, health-related questions. And if the client answers no to all of them, so they're just trying to eliminate any major sort of illnesses or diseases that can be, that they can sort of come up with throughout these questions. So all of those questions have to be a no. So we're looking at someone who is generally healthy. And then the second one that has to be met in order for a TIA to be issued is you have to pay at least 1 month's premium. Now with the premium, the client has the option, either you can pay when you do your application, or you can pay when the policy is issued and delivered, or you can set up another time. Let's say the policy is delivered on the 1st of January and you want the payment to be taken out on the 4th or 5th of January, right? So you have the option to sort of set that up. But what's important is that your policy is not actually in effect until a payment is made, right? So if you're getting a policy for $500,000, it's not actually enforced until you make a payment, because the insurance company is not going to pay out anything if anything were to happen if you actually haven't paid for the product in the first place. Or you can set up it and you can get all the paperwork ready and have it all aligned, but the payment is when the policy is actually enforced. So payment is obviously very, very important. I like to give an example of like online shopping, if you can connect to that as well. So you can add as many things as you like in your cart, but until you actually put in your credit card information and hit submit, you're not going to get an order number or a shipping number or anything like that, right? So you have to make that finalized. So if they're not paying the 1 month's premium, this TIA is not in effect. So those are the 2 conditions that have to be met. And the purpose, what is the purpose of a TIA? Obviously, the key purpose here is that it is providing a peace of mind. So it gives clients, especially if clients are going away, if they're traveling, it gives them a little bit of peace of mind that they have some sort of coverage, right? So it might not be the full amount that they're applying for. TIA will always cover for a lower amount. So they can get, let's say if they're applying for $1 million, their TIA is 500,000. If anything were to happen, it will cover for the 500,000. So it will cover for the lower amount, but it's better than none. Right, so it gives a peace of mind to the person that they do have some sort of coverage. At least they're not walking around with no coverage at all. Right, so this is how the TIA works. We're just going to switch over now to looking at changes in insurability, because they do go hand in hand with this as well. All right, so let's go ahead and switch over. All right. So continuing on, so we finished going over the TIA. The next part we're going to be connecting in this segment is something called changes in insurability. Now, this is a very important part of the delivery process of the application. So what does this mean? So changes in insurability, and whenever we're saying that, we are usually talking about some sort of a negative change, right? So has there been any change for this client where we can say that they're no longer insurable? And what do we mean? So any sort of change in health. So let's say when you did the application, they were perfectly healthy, everything was fine. You come back and now they are sitting in a wheelchair. So there's clearly a change in their health. There's a change in their insurability. Would the insurance company still have issued that same policy if that was their condition before? So this is important. Or in occupation, let's say they've lost their job. When you're issuing the policy, you're going to base it on their job as well. So if they've lost that, maybe they might not qualify for the same amount of coverage, right? So those are key things that if anything has happened. Now, with the exam question, and even in real life, many times, clients will give you a very perfect logical explanation. Maybe, you know, I'm only in this chair temporarily, sprained an ankle, will be back on my feet in 2 weeks, which might be 100% true. You know, we don't want to always doubt and say that they're lying, it might be true, but according to the rules that we have, if you notice any sort of change, you cannot deliver that policy. So what happens to that policy is you have to make a note of that change, and that policy goes back to the underwriter, and they have to reassess and figure out if they still want to issue it, or do they want to do more tests to make sure everything is okay. But you cannot deliver the policy, right? So that's a key thing. If it's the other way around, if they got a big promotion and they're earning more, then it's not going to make the insurance company say, no, we're not going to issue it, right? So it's usually some sort of a negative change that we're looking that applies for this, right? And why is that important? Why do we care about the delivery of the policy? Because the delivery of the policy is when you have the 10-day free look period. And what does that mean? It's also known as the recession period. And from the date of the delivery, they have 10 days to change their mind without any penalties. So this is now, it's kind of like the probationary period. They're not officially into the contract until those 10 days are up. So if they change their mind, they decide, I don't really want this anymore, they can do that within those 10 days without sort of having any penalties or any sort of anything that is going against them. After that, they're kind of locked into that contract. And then it would be a cancellation and not just not just something that they're changing their mind. Right, so that is very, very important in terms of the delivery of the policy. All right, perfect. So we'll continue on in our next segment. Thank you so much for joining.